everyone, John Henry here from School of Trade, and today we're going to be taking a look at the dead cat bounce pattern. Now, this is a very simple and effective way to trade news events or fast-moving markets or anything that's just too difficult to chase. A lot of times when you run into those areas, whether it's news, especially on gold or some of the indexes, where price goes just so fast when those news numbers come out that you don't want to chase after it because you're going to get in really late. And that's one of the most enticing things that a lot of newer traders do is they chase after those trades and then it comes back on them and stops them out. So we want to avoid that kind of stuff by looking for a dead cat bounce pattern, which is essentially letting the news move do whatever it wants to do and then letting it pull back to us so we can get into the trade and then push it back in the original direction it was going. So as an example right here on gold, I just have an example of an abrupt pattern or an abrupt price action shot up right here earlier in the morning. This happened at right around 3:50, 4 o'clock in the a.m. And this is on the 19th, so just a little bit a ways away. These patterns don't set up good looking, at least, very often. So you do have to do a little bit of hunting to find them every once in a while. Typically, you'll have some other rules that will kind of invalidate that pattern itself, and it's just easier to make sure that you're using those rules effectively so that you don't want to get into a bad trade. So looking at this abrupt shot up here in price action, obviously we don't want to chase after it because if we chase after it, we're going to be getting in at, right at the highs, 1300.4, or even worse, 1301.3. And zooming in on this, you can see a lot of people did that. They bought right up at these highs, and what happens? Price immediately pulls back on them. Well, you don't want to be buying up here. That's a terrible idea. We want to wait for price to actually come down into a zone that we can look to become a buyer and then push price back up to new highs. So what we want to do is we want to use our Fibonacci retracement tool here, and we want to measure from the highs of the move after that news announcement to the lows where the candle started itself. So I'm going to measure from high to low and then just right back up to the highs again. What we're looking to do is we're going to be looking for price to retrace back to the 50%. And that's going to be a key area where you want to see what type of reaction you're going to have at that 50% level. And right here, when we came back to that 50% level, we bounced off of it once. Now, if you were aggressive, you could have entered there. Alternatively, this candle looks a lot better. It's a lot more bullish, bounced off of it. It's all wick. And you'll notice a key factor in this. Nothing is closing underneath that level. All it is just stems, bunch of little stems down here, and that's all there is. And that's a really important part. You don't want to see candles closing down there for too long, maybe one, not much more than that. You want to actually see candle rejection like we've got right here. This is a really nice entry right here because the candle looks perfect. It's a second attempt at that level right there. Just a really nice entry area to go long. So your entry would be off of that candle, so you could go in off the highs, or if you wanted to wait for a little bit more confirmation, a break above the highs of that candle is fine as well. But that's going to be the entry point. So now we're entered into the trade. Where do we place our stops? Where do we place our targets? How do we actually manage this trade? Well, the first part is we need to get our stop placed correctly, and the stop is going to go below the 50% level. And if you've already got a swing back there, is an example, if you were waiting for the candle confirmation, you can just drop your stop right below that candle right there, and that's a perfect spot for that. Give it 1 or 2 ticks underneath there, just as a little bit of a buffer. Now, the first target is going to be at the highs, and you want to make sure to take your first target off there because it bounces almost always in that level. And you can see it came up to that level, tested it to the tick. That was a to the tick touch, and then it rejected right back down again for another area to possibly get in. So you do have a couple opportunities. You've got one buying opportunity, second one, even a third one here. You've got a lot of different options to hop in this trade, but you always want to make sure to take your profit off at that swing high. That's a key area because that's the high of that news move. That's where the price moved with that big chunk of volatility that came in. So it's an important level. Now, once you get past that, the next level is going to be the negative 100% or the 100% extension up here, this level up in this location here. In this case, it's at 1305.9. And you can see price came really close. It came, I believe that's 2 ticks away and then rejected right down. It actually gave you a double top, which is a big sign to get out. But just like all the other levels we use, you don't ever want to put it right on the level. And this is exactly why. Because if you were to place it right on that level, you would have missed your profit target and it would have come all the way back down and stopped you right out break even. So keep that in mind when you're looking at these patterns, because when we moved up here, it went up to 1305.7. It was at 1305.9. I usually front run by 3 or 4 ticks, so it would have been out at 1305.6 with 1 tick to spare. And that's why you always want to front run those levels, because of stuff like this. So now we've essentially gone through the entire trade. That's the dead cat bounce. It's a very effective pattern, but you want to make sure a key element in this is you want to make sure to actually see the rejection in these levels. If you're not seeing that rejection, it's not going to be a good pattern. A lot of times a bad pattern will, close underneath it and then kind of meander around a little bit and then continue back lower again. It's not a good area. You want to make sure to see this clear rejection. And we can see here, just off of this one level, you could have bought once, bought twice. They front run it maybe a little bit, but bought 3 times, and then the 4th time, then it's all in that same level. And you'll notice again, nothing ever closed underneath that level until we hit that target. And that's the key part of that pattern. So that's going to be taking a look at the dead cat bounce pattern. If you have any questions about it, feel free to send an email to School of Trade, and don't forget to check out our trial at SchoolOfTrade.com. Have a good one. Bye.